Every year, somewhere between February and September, real estate LPs around the country get the same email. Your Schedule K-1 is ready in the investor portal. And for many of them, especially in their first syndication, the reaction is some version of, "I have no idea what to do with this." In this video I'm going to explain exactly what a K-1 is, how to read the numbers that matter, what your CPA needs from it, and the tax mechanics that make real estate a uniquely powerful asset class for W-2 earners. First, what is a K-1? When you invest in a real estate syndication, you're typically a member of an LLC. LLCs don't pay taxes at the entity level, income and losses flow through to the members. The K-1 is the document that reports your share of the LLC's income, losses, and deductions to you, and to the IRS, for the tax year. You don't file the K-1 itself. You take the numbers from it and your CPA enters them into your personal tax return. The K-1 comes from Schedule K-1 of IRS Form 1065, the partnership return. The LLC files the 1065 at the entity level. Each member gets their own K-1 with their allocable share. Here's how to read a K-1. Box 1, Ordinary Business Income or Loss. For real estate, this is typically a loss, because of depreciation. This is the number your CPA needs most. A negative number here means the property generated a paper loss allocated to you. Box 2, Net Rental Real Estate Income or Loss. Some deals structure rental income through Box 2 rather than Box 1, depends on the entity structure. Your CPA will know which box applies. Box 3, Other Net Rental Income or Loss. Less common but appears in some deal structures. Box 19, Distributions. This is the actual cash distributed to you during the year, what was deposited in your account. Note, distributions and income are not the same thing. You can receive distributions and still show a paper loss. Box 20, Other Information. This is where you often find items like Section 199A Qualified Business Income Deductions, Section 1231 Gain Information, and other deal-specific items. If your deal did a cost segregation study, the benefit shows up through Box 20 codes. Write down these four: Box 1 or Box 2, the loss, Box 19, distributions, and Box 20, other items. Give your CPA the full document, but these are the numbers that will matter most on your return. Now let me explain why real estate LPs often show a loss on paper even when the deal is profitable. The answer is depreciation. The IRS allows real estate investors to deduct the cost of a property, the structure, not the land, over its useful life. For residential property, that's 27.5 years. Commercial property is 39 years. This means a property that generates positive cash flow every year can also generate a paper loss that flows through to LPs on their K-1. Here's a simple example. The LLC owns a property worth $1 million. Land is worth $100,000, the building is worth $900,000. Divided by 27.5 years, annual depreciation of roughly $32,000. If the property generates $20,000 in net operating income, it made money. But after depreciation, $20,000 minus $32,000 equals a paper loss of $12,000. That $12,000 loss flows to the LP based on their ownership percentage. The important question for W-2 earners: can you use that paper loss to offset your W-2 income? Usually, not immediately. Here's why. The IRS classifies real estate rental losses as passive losses. And passive losses can only offset passive income, not W-2 wages. There is one exception, the $25,000 passive loss allowance. If your modified adjusted gross income is $100,000 or below, you can deduct up to $25,000 of passive real estate losses against ordinary income, including your W-2. That allowance phases out between $100,000 and $150,000 MAGI. Above $150,000, the allowance disappears entirely. So for most investors with W-2 income above $150,000, the paper losses are suspended. They accumulate. And here's the key: when the property sells, all of those suspended losses are released in the year of sale, offsetting the gain. This is one of the primary tax benefits of real estate for W-2 earners. Not an immediate deduction, a deferred one that becomes powerful at exit. Now let me explain 2 ways investors unlock those passive losses, even with high W-2 income. The first is cost segregation. A cost segregation study identifies components of a building that can be depreciated on an accelerated schedule, 5, 7, or 15 years instead of 27.5. Parking lots, landscaping, flooring, certain electrical and plumbing components. These are identified and separated, segregated from the main structure, and depreciated much faster. The result: dramatically higher depreciation in early years of the hold. On a $1 million property, a cost seg study might identify $200,000 to $300,000 in 5 or 15-year components. That gets depreciated in years 1 through 5 instead of spread over 27.5 years. For deals with a cost seg study, LP K-1s often show a large paper loss in year 1, sometimes larger than the LP's initial investment. For passive investors, that loss is still suspended unless they have other passive income to absorb it or qualify for the real estate professional exception. If your GP mentions a cost seg study in the deal summary, ask where that accelerated depreciation goes in the K-1, and whether it's structured to benefit LP returns or just improve the GP's own tax position. The second way to unlock passive losses: real estate professional status. The IRS allows taxpayers who spend more than 750 hours per year in real estate activities, and where real estate is their primary profession, to reclassify their real estate losses as non-passive. If you qualify, passive losses from all your real estate investments can offset W-2 wages directly. The bar is real: 750 hours annually. Real estate must be your primary professional activity, meaning more hours than any other profession. There's a grouping election required. And it must be documented. For W-2 earners who are also active in real estate, not just passive LP investors, this is a legitimate strategy worth discussing with your CPA. For most passive LPs with no active real estate activity, you don't qualify. The losses remain passive and suspended. Now let me cover the K-1 timing issue, because this catches new LPs off guard. K-1s are notoriously late. Your individual tax return is due April 15th. But the LLC's 1065 return, from which K-1s are generated, is due March 15th. And many GPs file for the 6-month extension, which pushes the 1065 deadline to September. That means your K-1 might not arrive until August or September. This creates a choice: file your personal return on extension and wait for the K-1, or file your return using a K-1 estimate and amend later if needed. Most CPAs who work with real estate investors routinely file client extensions to accommodate late K-1s. If you're investing in multiple syndications, expect to file on extension nearly every year. When you start a new investment, ask the GP, when do you typically distribute K-1s? This tells you what to expect and helps your CPA plan. Here's what to bring your CPA to prepare for your real estate K-1 conversation. 1. Your K-1 document, the full form, not just the summary. 2. Your cost basis tracking. Every year you receive a loss allocation on your K-1, it reduces your basis in the LLC. Your CPA should be tracking this. Suspended losses are tracked by the IRS and become relevant at exit. 3. Any distributions you receive during the year, box 19 on the K-1, but also your own records of deposits. 4. Documentation of your real estate professional hours if you're claiming that status. 5. Any deal-specific notes from the GP's K-1 package. Most GPs include a cover letter or K-1 summary that explains the major items. Bring that too. If this is your first real estate K-1, it's worth a dedicated 60-minute session with your CPA to understand what's happening, why you're showing a loss, and how those suspended losses will factor into your eventual exit. Here's the summary. The K-1 is how your share of the LLC's income, losses, and deductions flows to your personal return. You don't file it, your CPA uses it. Key boxes: Box 1 or 2, the paper loss from depreciation; Box 19, cash distributions; Box 20, additional items including cost seg benefit. Passive loss rules: most W-2 earners above $150,000 MAGI cannot use real estate paper losses immediately. They suspend and release at exit. Cost segregation accelerates depreciation into early years. Real estate professional status unlocks passive losses for qualifying investors. The bar is real. K-1s are late. File on extension. Tell your CPA when you invest. The LP due diligence checklist has a tax section, linked in the description. Free download. Subscribe for the next video. We're going to cover how to evaluate a GP's track record, what the numbers actually tell you, what to ask for, and how to spot a track record that looks better on paper than it really is. Thanks.